In this video, I'm going to be going through a complete A to Z of the Forex market structure and liquidity strategy that I have used in order to generate results such as these. At the end of this video, I'm also going to be providing you guys with a complete trading plan to accompany the strategy. So if that also sounds interesting to you, make sure to stick around to the very end of this video. Make sure to like and subscribe, and let's get straight into it. Alright guys, so first of all, I'm going to take you through the complete strategy as I mentioned, A to Z. So the contents of this video are going to include how to identify market structure and supply and demand, which is the foundation of this strategy. It's a pure price action strategy, so we start off by identifying overall market structure using naked price action, and then we go ahead and add a few other confluences into the mix as well. Step 2, I'm going to be taking you through the different types of liquidity that I use in this strategy to add extra confluence and add probability to any given setup. In the third part of the video, we're going to be going through a simple and repeatable entry method that you can use every single trade. As I mentioned, it's going to be a repeatable process, meaning that every single trade you'll be able to mechanically repeat this, and this avoids any confusion that you would normally have in a discretionary system. So you know exactly what to look for in order to enter, also what times, and exactly what you need to see in order to enter a trade, where the stop loss is going to be, where the take profit is going to be. So I'm just going to be going through a set of mechanical rules that you can use. And at the end of the video, like I mentioned, I'm going to be taking you guys through and giving you for free a full trading plan, which I will also leave in the description box below. So if you guys want to check out that, wait until the end of the video, so you've obviously learned the strategy first, but I will leave a link to that trading plan in the description below, and you can go away and adapt it if you wish, or keep it how it is in order to put on your trading setup so it's always right in front of you to reference. And the final step is, as always, I'm going to go through a few examples of this strategy to make it more clear, as a lot of people will probably be more visual learners. So yeah, the examples are definitely a big help, so also make sure to stick around to the end of the video to take advantage and see those. But yeah, let's get straight into the video. So the first step, before we go over to types of liquidity, we want to identify overall market structure and supply and demand areas. So if we treat those as two separate points, and first of all go through my definition of how to identify market structure. So this is going to be a very basic overview of market structure. So basically what we want to see is price to be either printing higher lows and higher highs like this, or simply the opposite in a downtrend where we're printing lower lows and lower highs. For the labeling, we want to mark on our breaks of structure and our changes of character. So starting off with a break of structure in an uptrend is when price makes a pullback like this and then pushes up, breaking past that most recent high to form a higher low. So this would be a break of structure, and this here would also be a break of structure. In a downtrend, we have the opposite, where price pushes down, does a little mini retracement, and then pushes back down, taking out the most recent low. Pull back, push down, take out the most recent low, and that is our break of structure, like so. And for a change of character is simply a break of structure in the opposite direction to the trend, which is a signal of a trend reversal. So it would look something like this. So as mentioned before, we have our main breaks of structure just here. That's a break of structure, but a change of character is observed when price breaks out of this pattern of forming higher lows and higher highs and breaks and closes below the most recent higher low. For this strategy as well, it's very important that price actually closes below this low. You don't want to see it just wick below, because then it would be invalid, at least according to my rules. So we want to see a clear closure past the most recent higher low. That's a change of character. And then we can say that the trend has turned from bullish to bearish, and then this would be a break of structure to confirm the newly formed bearish downtrend. And obviously we can just flip that. In the case of a downtrend, flip into an uptrend. So if we have a downtrend like this, where price is breaking structure here and here, and then price comes up, takes out the most recent lower high and closes above, and then we would consider that to be a trend reversal for price then to continue higher, and the change of character as it is at this point here, where price closes past the most recent lower high. So that's a basic overview of market structure. One thing I also want to mention about how I use market structure is I like to incorporate this idea of fractal market structure, which sounds a little bit complicated, but it's quite a simple concept. So imagine we're on the 4-hour time frame and we have an uptrend like this. When price is doing a 4-hour retracement, let's say we're doing this, and let's say we have some sort of 4-hour zone that we're looking at this point. So even though this is a 4-hour uptrend, on the lower time frame, this move here will appear as a downtrend on the lower time frames. So let's say we're on the 15-minute time frame and we're currently inside this retracement leg of the 4-hour trend, where we've had this most recent break of structure here. On the 15-minute time frame, this will appear to be a downtrend. So we will see something like this on the 15-minute as price is approaching our 4-hour level of demand, which we will get into in a moment. But imagine that price is doing this 4-hour retracement. This appears as a 15-minute downtrend with structure like this. So we have a downtrend in structure where we have break of structure, break of structure, break of structure. And then what we are anticipating price to do is once it comes into our 4-hour level, we want to see price take out that most recent lower high of the trend and then continue over in the overall main higher time frame bullish trend, where we have the change of character after price closes below this most recent lower high. And that is basically the foundation of this strategy, is to identify market structure in this way. So a lot of you guys will probably already be familiar with identifying the higher lows, lower highs, and changes of character within the market. But just for those who don't, I just wanted to clarify that. So going over to step 2 now. This is going to be the types of liquidity that we're going to be using within this strategy. So there are 4 main types of liquidity that I use. The type 1 is the Asian range. So if you live in the UK, the Asia session is between 11 PM and 6 AM. And particularly with pound pairs and USD pairs, you will often notice that during these times between 11 and 6 AM in the Asia session, price tends to just be very choppy and consolidate. We don't really have any directional movements to the upside or the downside. It tends to just be sort of sideways price action like we can see in the picture down here. So the Asia range here was between this point and this point, and you guys can see that we were just consolidating. Price was very choppy, and this would have been very low probability conditions to take a trade in, which is why we wait for London session in order to take the trades. But just a introduction to the Asia session, it's basically between 11 and 6 a.m. and price tends to be very choppy and consolidates a lot during this time. So in London session, there tends to be a repeating pattern of events that usually occur. So at London Open, which is 7 a.m. in the UK, price usually manipulates the Asia high or the Asia low and then moves in the opposite direction to come and seek opposing liquidity. So to clarify that, if we just refer to this picture down here for 1 second, you can see that price was in this Asia consolidation. When London session opens, we come down, take out the Asia lows into an area of demand, and then price moves in the opposite direction, targeting opposing liquidity. So once it has taken out buyers, as we can see here, it comes for sellers, and obviously vice versa. So how we actually use this in our strategy is, let's say price is in a bullish trend and price has come into an area for our demand. What we want to observe is for price to give us a lower time frame entry confirmation, which we will go into in a later part of this video. But basically the lower time frame confirmation is when price comes into that 4-hour level of demand or supply. Then we observe on the 15-minute that change of character, so that the lower time frame trend realigns with the higher time frame trend. In this case, the 15-minute realigns bullish with the overall higher time frame bullish trend. And how we use the Asia range is we want to see the Asia liquidity being built above our entry area on the 15-minute time frame, which I will go into in a moment, like I said. But yeah, this is a simple introduction to the Asia range liquidity. Basically, to summarize all of that, Asia tends to consolidate, particularly on pound pairs. And in London session, you will normally see a manipulation of the lows or the highs before price then makes its real move in the opposing direction. So liquidity type 2 is something called an inducement. And an inducement is simply when price comes very close to an area of supply or demand but doesn't mitigate it. And then price will usually come back to this area of demand at a later time or date, taking out the inducement or the low that got very close to it but didn't touch, and then it uses that as liquidity to fuel the move in the opposing direction. So if we look at the example below, we can see that price switched bullish on the 4-hour time frame with this change of character where we went from printing a lower low and a lower high, lower low into a higher high. That confirms the overall sentiment shift from bearish to bullish. Price then pulls back, comes very close to tapping this area of demand. As you can see just here, we didn't actually tap the demand, but we came very close. Price then makes its move away from the zone, and at a later date we come back, taking out this liquidity, tapping into the demand, and then price flies over to the upside. And the reason it had basically enough momentum and enough fuel to move over to the upside at this specific point was because it had taken out this area of liquidity to the left, which was the inducement above the area of demand. Type 3, this is probably the most common type that everybody talks about. It's basically equal highs and lows, or double tops and double bottoms. And this is when price generates multiple equal highs and lows within a specific area, usually above or below an area of supply / demand. And the theory is basically that because we have multiple, let's say we're looking at a bearish example, because we have multiple highs below an area of supply, price is accumulating orders, which obviously represent liquidity. And in order for price to move, it needs to take liquidity. So the theory is that because price has generated all of these equal highs, it will take out these equal highs before then continuing over to the downside, because it needs that fuel, i.e. money, in order to move over to the downside and then target opposing liquidity perhaps at the low. And the final type I wanted to mention is trend lines. So we all know that a very basic retail methodology of technical analysis is to incorporate trend lines. So the trend line being when prices move in sort of like a descending fashion like this, where price tends to be respecting this specific diagonal line. That's what a trend line is. And similarly with the equal highs and equal lows example, simply all price is doing when it is respecting a trend line like this is it's building up orders for then price to purge at a later date, like we see here, where price wicks above that trend line into an area of supply, which was also left imbalanced. And then it has basically enough fuel and has collected enough liquidity in order to move over to the downside and target opposing liquidity at the lows. So that's a basic introduction to the types of liquidity. Before we get into the lower time frame entry model, I just want to clarify how I personally draw areas of supply and demand for anybody that's a bit confused on that subject. So starting off with the definition, an area of demand, if we get the text tool. So an area of demand is, for me, the last the last sell candle before a big impulsive up move, which creates imbalance. So if we just write that on, so it's the last down candle before an up move that created imbalance. And a supply area is simply the opposite. It's the last up candle before a down move that created imbalance. So if we just look at a few examples to clarify what I mean by that. So if we look at the price action here, we can identify multiple levels of supply and demand, but just to draw out a few, we have, actually that's a bad example. If we go, let's go over to here. So an area of supply, as stated up here, is the last up candle before a down move that created imbalance. So we can clearly identify this zone here, which is the last up candle before the down move, which created this imbalance. And when we're identifying these areas of supply, we want to identify the one which created the imbalance. So, for example, we wouldn't identify, say, this one all the way up here because this imbalance was already filled. So we want to identify the one which created the imbalance. An added confluence as well for the strongest areas of supply and demand is that they have to create a break of structure as well. So notice how this area of supply took over demand and caused this low to fail. That means it's a very strong level and price is likely to come back and respect it. If we have a look at some others now, perhaps on the lower time frame. So another good example is here. We have this 15-minute level of supply, which is the last up candle before the down move, which created imbalance. And we also took out this previous low and this one here as well from this area. So I suppose a better definition, or we also have an area of actually here. So this would be a better example. The last up candle before this huge down move, which created imbalance and took out structure to the left. We also had in this case some sort of trendline liquidity below that area as well for price to come up and take. So if we go back to the higher time frame and see if we can identify some areas of demand now instead. So going back to the definition, it's the last down candle before an up move that created imbalance. So if we go back to this point, we can see this is an area of demand here very clearly. The last down candle before an up move which created imbalance and took out this area of significant structure to the left. We also then had some liquidity resting above it. And what does price do? It comes down, takes out liquidity into an area of demand, and then continues over to the upside once it has confirmed that bullish sentiment upon breaking this structure, which was the most recent lower high in a downtrend. And you guys can see, once we tap that demand and take liquidity, price has enough fuel, or it has taken enough liquidity, enough money out of the market in order to move over to the upside and come and seek some previous highs or previous sellers in the market. One more example of an area of demand before we move on would be if we go through a lower time frame example. I think that was a good example just here actually. So we can see here, after price flipped bullish when we took out this structure, that's our change of character, because price was printing lower lows and lower highs. Once we came to this higher time frame level to the left, price then broke out of that downtrending structure, switched bullish after we got the confirmation when price closed above this most recent lower high. And then our area of demand would be this one right here, which is the last sell candle before an imbalanced up move, which led to the break of this structure as well. And we had multiple areas of liquidity resting above this zone as well. We can also then identify a further area of demand just here, last sell candle before an imbalanced up move, which took out structure to the left and has liquidity resting above it. In this case, we have inducement liquidity. Price comes very close to demand, moves away, but doesn't actually touch it. And then at a later date, it comes back. If we keep playing price, at a later date, as we can see, price comes back into that area of demand, taking out these two equal lows and inducement, because this is inducement because price came very close but didn't actually touch it. Price then later comes back, takes out that inducement liquidity into the area of demand, and then continues its move over to the upside. If we just keep playing that to emphasize the point, there you go. So that's basically how we draw the areas of supply and demand. And actually, before we move on, I wanted to mention that I personally draw the areas of demand across the whole candle. So if it's an area of demand, I draw the area of demand as the top wick to the bottom wick of that last sell candle before the up move, like so. If it's an area of supply, I draw it also around the whole candle. So last up candle before the down move, which created imbalance and also broke structure. This here would be how I would draw the area of supply around that whole up candle, like so. So yeah, that's how I draw the areas of supply and demand. But now if we go back to the PowerPoint and get into some more of the intricacies and little details of the strategy itself. So as for the lower time frame entry model, I mentioned that it would be a repeatable entry model and as mechanical as possible. So these are the main steps of the entry model that I want to break down. Even though it is 7 steps, they are very simple, and some of them you could probably combine into 1 or 2 steps anyway. So step 1, price comes into our higher time frame area of supply and demand after taking higher time frame liquidity. So if we go over to the charts and we will go through example whilst I explain the steps of the system. So let's go to this point right here. So at this point right here, we can clearly identify that price was in an uptrend. That would be step 1 of the strategy, to identify overall market structure and direction. And for me, the most recent 4-hour breaker structure would be this one right here. We can also identify a higher time frame level of demand just here, because this was the last down candle before that imbalanced up move, which broke structure to the left. We also had an area of liquidity resting above, as we can see, plus that imbalance, plus that demand. So this would be step 1 of the strategy, to simply identify the overall market structure on the 4-hour time frame, which at this point in time was bullish. Step 2, which we already did, price comes into an area of higher time frame supply or demand after taking out that higher time frame area of liquidity. So there we go. Price has come into our higher time frame level of demand. Going back to the entry model, we want to observe a 15-minute flipped back in line with the higher time frame after price breaks and closes above the most recent lower high. This is for a bullish example. So basically we want to see a 15-minute change of character. So if we go back over to the charts and see if we can identify that. So at this point, we would be on the charts monitoring for a potential entry. And what we would be doing, or what I like to personally do, once price comes into my higher time frame level of interest, is mark on the most recent break of structure, which in this case is here. So remember at the start of the video, I mentioned fractal market structure. So even though that the 4-hour time frame is bullish, when price is retracing into our higher time frame level on the 15-minute and the lower time frame, this is going to appear as a downtrend, as we can observe here. Price is printing these consecutive lower lows and lower highs and is overall trending to the downside. So our job, once price comes into that higher time frame level of demand, is basically to observe a switch in this downtrend and for price to flip bullish, so that the 15-minute time frame is aligning with that 4-hour bullish time frame. So once price comes into the level, what I always do is mark on which level I would want to see broken in order for that confirmation to materialize. So in this case, this was the most recent break of structure. Therefore, this is the most recent lower high. Therefore, this area right here is the high that I would want to see broken past in order for us to have a valid confirmation. So if we continue to play price, there we go. That would be our change of character. Also, remember that I said we need to see a clear closure above, which in this case we got. We actually closed above this with quite a bit of momentum as well, which is very important, as a lot of the times you will see if price just wicks above this area, it could be a liquidity grab for then price to continue selling, which is why we need to see that clear closure past the level, and ideally a closure with a lot of momentum as well, as we have in this case. Moving on to step 3. Price leaves an imbalanced level of demand on the 15-minute time frame, which we then want to identify. So in this case, we can clearly identify this 15-minute level of demand just here, which was the last sell candle before the up move, which took out this structure to the left and left this area of imbalance as well. So that's step number 3, very simple. Step number 4, we need to observe one of the 4 types of liquidity above that area of demand. And then step number 5, enter via a limit order. So just a reminder of the types of liquidity. We have Asia range, inducement, equal lows or highs, and also trendline liquidity. So if we go back to the charts, we can get up our Asia range indicator, which plots on the Asia range for us. A good one to use is this one by Nico948. It plots on this gray box, which represents the Asia high and the Asia low, and the box ends when Asia session ends and it starts when Asia session starts. So if we continue to play price, we eventually observe that this right here would be the start of the Asia session, as you can see by the gray box. So if we go back to here, this would be around the time when we would wake up and we would be monitoring the charts for the London session. So at this point in time, we would be thinking to ourselves, we've come into that 4-hour level of demand. We've had that 15-minute confirmation. And in Asia session, we began to consolidate above this area of demand. So step number 5, as mentioned, is to then just set a limit with a stop just below the wick of the area of demand. And then going back to the PowerPoint. Actually, I didn't mention that on there. But for the take profit, we're simply going to be targeting a 1 to 3. Which in this case would align with this level. If the trade, or if you think the trade may reverse before a 1 to 3, we simply do not take the trade, as the risk to reward is not there and it's not worth risking the 1%. So if we play price, we can then see that price takes out that Asia low, tapping into our level of demand, and then it has no reason to continue lower. So it goes for opposing liquidity at these previous highs. So yeah, that is a breakdown of the lower time frame entry model that we're going to be using. And here is another perfect example of this entry model playing out. So in this case, price was in a higher time frame demand to the left. Price was overall in a bullish trend. We then would mark out this as our most recent breaker structure. This is the most recent lower high that we would want to take. Price then closes past that area with momentum. Price then leaves behind this imbalanced area of demand, last down candle before an imbalance up move, which took structure to the left. Price then left this inducement in the form of a higher low. You can imagine that this area here represents where people would be buying on a pullback, perhaps a retest of this previous high. But we know that since there is this imbalance below and this unmitigated level of demand, price is unlikely to react and continue higher until it comes lower into this area of 15-minute demand. You can also see that on the way down to this area of demand, we created these 2 equal lows above, and also this sort of trend line liquidity here, which is a good indication that price will at some point pop up, take out this liquidity and take out these 2 equal highs as well. We know also that there is a very low probability of price continuing and taking out the previous lows until it takes out this trend line liquidity above. Okay, so one thing I didn't mention, when we're looking at these lower time frame entry models, sometimes we will see that once we've identified our initial area of demand to enter from, price won't always pull back to the level. And I see a lot of people get confused with this, is what happens if price continues higher, misses your initial level, and just simply continues over to the upside without giving a pullback. So step number 7 is basically to identify new zones on the 15-minute time frame following the 15-minute structure if this does indeed happen. So for example, in this case, we can observe that price closed above that most recent lower high, giving us the change of character. This is the 15-minute time frame as well, by the way. Price then pulls back towards our level of demand, but doesn't quite tap it, and simply continues to fly over to the upside like so. And as you can see in the picture on the right, price never comes back to this area of demand. So this point here is where the London session opens. So we are no longer anticipating that price is going to come all the way back down to this level. And we can also kind of rationalize as well that if price does come back to this level, it's probably bearish because it would have broken past multiple levels of this uptrend in structure. So simply what we do in this case is identify the 15-minute structure and go with the order flow of the market. So we want to mark on our main higher lows and higher highs, where we have in this case a pullback. Price then pushes up, breaking past this structure. This area here was the Asia low. Price comes back, manipulates the Asia low, sweeping that liquidity, and then on the 5-minute we want to identify that entry model. So whereas before we were looking at a 4-hour area of demand and then a 15-minute for our entry confirmation, if we're following the 15-minute structure, we identify a 15-minute area of supply or demand, and then we go down to the 5-minute to look for the same confirmation, where we see price break past and close past the most recent lower high with liquidity above an area of imbalanced demand. That's the same thing as we're doing here, but on the 5-minute time frame. So our entry would be here, and we would be targeting somewhere up here, perhaps at the previous higher time frame high. But yeah, if price does end up doing this to you, just simply follow the 15-minute structure. Don't stay married to this initial level. I've made that mistake myself a few times, but more often than not, if price moves with all of this momentum, it's not going to pull back into your zone. So the best thing to do is just to simply adapt to the market structure and follow the flow. So before I end this video, I want to go through one more example of the strategy just to clarify. And for this, we will go over to gold. On a Wanda. And the example I wanted to go through was over here. So at this point in time, we start off on the daily time frame. First step of the strategy is to identify overall market structure and direction on the 4-hour and the daily time frame. So how I would be viewing this is we have this daily break of structure just here. Price has come back to mitigate this extreme area of daily demand. As we can see, this is an area of demand because it's the last sell candle before this imbalanced push up, which led to the break of this structure to the left. Once price came into that daily area of demand, we were looking at this sort of internal downtrend within the overall predominant uptrend. Price then had this daily change of character just here, where we went from printing a lower low, lower high, lower low to a higher high. So what we are anticipating now is for price to come a little bit lower, give us that retracement to form a higher low into a higher high and continue higher. So going over to the 4-hour time frame, we can then see, actually if we go a little bit lower, we can then see that we had this area of demand, last sell candle before the imbalanced push up, which took out structure to the left. We also have this inducement low resting above the area of demand. So we would be monitoring this level of demand for our 15-minute confirmation. Once price came into that level of demand on the higher time frame, we can actually refine it to this 15-minute candle as well. You guys can see this 15-minute candle here. That was the demand which created this imbalance. Once price comes into this level, as in our previous example, we would want to mark out the most recent break of structure in this 15-minute downtrend, which would be this break of structure right here, which means that this high is the most recent lower high of the 15-minute downtrend. Therefore, this is the high that we want to see broken past in order for a confirmation entry to be valid. So if we just draw that on, we would then be waiting to see if price gives us that confirmation or not. Which eventually we get on the 15-minute time frame. So now we have had a clear confirmation entry. What we would simply do now is identify if we have an area of imbalanced demand with liquidity resting above to enter from. So what we can clearly identify in this case is that we have this candle here, which was the last sell candle before this up move, which caused the structure break to the left. And we also have this inducement liquidity resting above the level. So we know that there is a high probability now that price comes down and forms a higher low and continues higher, because 1, we are overall in a higher time frame bullish trend. 2, price has come into an area of higher time frame demand. 3, on the 15-minute time frame, we've had a switch back bullish in line with the higher time frame once price broke this high to the left. And 4, we have an imbalanced level of demand with liquidity resting above it that also created imbalance. It's also at an extreme of this current leg from this low to this high. And by extreme, if you're not familiar with the term, I simply mean that if we were to draw the fib tool, it's below a 50% retracement of this move. So we would simply then set a limit on this area with a stop probably below this wick, just in case price wants to take the low of this demand. And then we would be targeting this most recent trend high. And as we can see, price taps into that level to the pip and eventually continues its move over to the upside. There we go. You could have also identified this zone on the 1 hour. It was a little bit cleaner, like that. But as you guys can see, this strategy normally works with pinpoint accuracy because it's based on the idea of this liquidity in the market. And the theory is that once price takes out, say, previous buyers, it will nearly always head for previous sellers. The only exception I would consider for this rule is when price is moving with a lot of momentum. So in this case, we're moving with lots of momentum. So once price takes out these previous sellers, it doesn't immediately pull back and take out previous buyers. Also, you also want to make sure and consider the higher time frame trend. So yes, in this case, price did take out these previous sellers, but price was overall very bullish, so we would not be considering sells, even though we know price is likely to retrace once it takes out those previous sellers, and it will most likely head for previous buyers. But yeah, that's a very simple overview of this strategy. And as mentioned in the start of the video, what I wanted to do now was give you guys a free trading plan to go away with in order to assist your backtesting and also your progress in the live markets. So here is the trading plan that I designed specifically for this video. So one thing about designing a trading plan is that you want it to be very simple. So you want it to have very clear and concise, unambiguous rules that you can follow every single time that you go to look for a position. You want to ideally know exactly when, so what times you're looking for positions, so you're not staring at the charts all day. You want to know what confluences you need to see, and you also need to know things like what pairs, what time frames that you're going to be trading, so you're not scrolling through every single pair and every single time frame. So I've outlined, first of all, the strategy itself in 3 clear steps. So step 1, identify overall market structure and direction. And then after this, you could also add on what time frame you're going to do that on. So for me, it would be the 4-hour and the daily time frame. Then breaking it down to the 1 hour as well, if we can identify clear hourly order flow. Step 2, identify a higher time frame area of interest or a point of interest. Type 1, imbalanced area of supply and demand, liquidity above or below, and following the overall prevailing trend. Type 2, liquidity pool taken out on the higher time frame, and then we see that confirmation immediately afterwards. I like to also include a picture as an example to reference when I'm about to enter a trade. So step 3, lower time frame entry model, confirmation entry. On the 15-minute time frame, we want to see a change of character plus imbalanced area of supply and demand, and also liquidity above the zone. So 3 confluences: change of character, imbalanced level of demand, liquidity above. If we're looking for sells, we want to see change of character, imbalanced level of supply, liquidity below. And then we can also refer back to the 4 types of liquidity that I mentioned: the Asia range, equal lows and highs, trend line, and inducement. And once again, I drew an example. And then moving on to the next section of the trading plan. This will vary depending on your own personality and also your own strategy, is what levels to actually target. So from experience, I found that this strategy works best if you're simply targeting a 1 to 3. So I've basically given you guys 2 options. You can either target inefficient levels of supply and demand with liquidity if you think price may reverse at these levels. Obviously, that's more of a discretionary system and sometimes can be a little bit subjective. So I would recommend, if you're new to this strategy and you're not yet profitable, just going for a set risk to reward ratio, such as a 1 to 3. Ideally, you want at least a 1 to 3 so that even if your win rate is low, the risk to reward makes up for it and you still end up being profitable. With a 1 to 3 risk to reward, you only need to have a win rate of 30% would be sufficient, no lower than 30%, I would say. So you're only winning 1 in every 3 trades, but you're still profitable. So yeah, money management, and this is probably one of the most important parts of the trading plan, where we specify how much risk we're going to be putting behind every trade. So for me personally, this would be 1% of my account balance. And the way we can actually calculate the correct lot size to use to risk 1% only of our balance is to go over to my FX book position size calculator. As we can see, and simply what this does, we input the currency pair we're going to be trading. So we input the currency pair that we're going to be trading. Say we're trading Euro USD. We put the account currency. So for me, this would be pound. We then can add in the account size, say £20,000. Risk ratio, this is how much risk percentage you're going to be taking per trade. So we want to put in here just a 1 for 1% risk. And then stop loss size, this is obviously going to vary on each and every trade. But say, for example, we use a 20 pip stop loss. Keep this bottom section as 1 and then just click calculate. I don't know what's happened here, but usually it will give you the correct lot size down here where it says sizing. And then simply when we go over to MetaTrader 4 and place the trade, we're going to input that lot size. And then it means that if the trade does end up hitting the stop loss, we've only lost 1% of our account balance. But when we win a trade, we will gain 3% of the account balance. And with a 30% risk to reward, with a 30% win rate, if you work that out mathematically over say a sample size of 100 trades, you would win 30 of those trades, meaning that we would gain 90%, and we would lose 70 of them. So 90 take away 70 would be a 20% gain over 100 trades. And then if you obviously scale that, say we take 1,000 trades, that would be an expected gain of 200% on the account. Obviously, this will also vary depending on what the win rate actually is. And if you guys also want to use a higher risk to reward I wouldn't recommend going any lower. 2 losses maximum per day, but ideally you would only be taking probably, I would say, no more than 2 trades per week. Myself personally, I normally only take around, on average, probably 5 trades in a single month, which works out as just over 1 per week. And the reason for this is because you want to be very selective with the trades you're taking, and you want to treat this as a business. So each trade is a financial decision, and as human beings, you are only mentally capable of making 1 or 2 financial decisions, big financial decisions every day. So definitely you don't want to be taking more than 2 trades in a single day, because then basically your head starts becoming irrational and you start making all these stupid mistakes. Actually, but I want to mention a prop firm statistic I found the other day as well. So most of the people that are consistently withdrawing from prop firms take on average 2 fewer trades per week than the ones that are consistently losing. So a key takeaway from this statistic is basically that the fewer trades you take, the more likely it is that you will be profitable. And you can kind of see why that is. If you're taking fewer trades, obviously a lot more thought is going behind each and every trade, and you're making sure that they are the most probable and high quality setups, quality over quantity. But yeah, you definitely want to have some sort of parameter which limits your maximum drawdown for the day, as you will see on prop firms. Normally on prop firms, this is about 4%, but you definitely shouldn't be losing 4% in a day. Max 2% for 2 losses, I would say. Moving on to the next point, only make it break even when there is some sort of high impact news. So let's say you're in a position when NFP is about to come out. If price is very close to your entry, I would simply just get out of the trade, because you don't want to risk the slippage. If price is already in profit, say by 1%, then make it break even, because you can still get slipped past your stop loss. And as mentioned above, minimum of a 1 to 3 risk to reward, otherwise no trade. And one thing I've also included is, for me, this was a big thing in the beginning. sometimes let's say I would be looking for a buy on gold. If I saw in the Discord group that another person was looking for a sell position on gold, I would maybe either switch my analysis to sells because I thought that person was a better trader than me, or I wouldn't switch the analysis, but I would hesitate and not enter my trade because I doubted my own analysis. So because of this, in this money management section, I've included this no Discord rule. Whilst you're looking for positions. And one other rule is, once you're in a trade, you want to ideally monitor it initially when price initially taps into your entry. But after that, I would simply set alerts at the stop loss and at the take profit, so that you don't make all these sort of psychological errors. For example, if price goes in your favor, like we see here, comes back to break even, you don't panic and exit the trade at break even because you want to avoid a loss. So this rule here, set alert at SL and take profit, basically stops you from making stupid, irrational and emotional trading decisions that are against your plan, which is the one thing that keeps most traders unprofitable and prevents them from making money. So yeah, that's all I wanted to go through in this video. As mentioned, I will leave this entire trading plan in the link in the description for you guys to go away, either modify or use as it is. Thank you guys for watching. If you made it this far, make sure to like and subscribe for more content, and I will catch you guys in the next video.